Hey everybody, and welcome back to Investing with Wesley. Today's episode, I want to tackle a pretty big topic, and it's also kind of a political topic as well. I want to talk to you about the Biden agenda's infrastructure tax plan, specifically when it highlights investing, taxes, and that sort of thing. And I'm going to cover 5 or 6 key points that's in this proposed tax plan that I think you should know about. So with that being said, let's get into it. Okay, so if you don't know anything about this tax bill, it is solely designed to quote-unquote tax the rich. Well, what does the federal government deem as rich? Well, the rich count up as 1.8% of the United States population, and they're individuals that make $400,000 a year or more in income. Now, political agendas aside, objectively speaking, it makes sense that the political parties would want to attack the rich because looking at a graph from 1990 to the present, the 1% saw the largest increase in wealth across all brackets and the largest pay increases across all wages. But I really want to specify that there is a difference between income and wealth. Income is any money that you receive inside your checking account. So that could be from working a job, collecting dividend payments, rental income, you name it. It's any money that you earn and that hits your bank account. Whereas wealth is something that doesn't necessarily hit your bank account. Wealth is the equity of the assets that you own. So you could own a house worth $1 million, but you don't have $1 million in your bank account. Same thing with stocks, bonds, mutual funds, ETFs, collectibles, art, all of that sort of thing attributes to your wealth, not your income. And I want you to understand the difference between income and wealth because it's just as likely that someone is earning a lot of money but still living paycheck to paycheck, whereas someone has no job whatsoever but has a portfolio over $100 million. One person has no income but is extremely wealthy, while the other person has a lot of income but is not wealthy whatsoever. And I want you to know that in the majority of these potential policies that are still waiting debate and approval, most of them attack your income and not your wealth. Now, the first thing they go after is specifically one method in the Roth IRA, and that is the backdoor Roth IRA. Now, if you're watching this video and have no idea what an IRA is versus a traditional IRA, I've made several videos on it that I encourage you to go check it out. But real quickly, the Roth IRA was created for the lower and middle class to contribute to their retirement and have it grow tax-free. Now, because it was designated for the lower and middle class, there's income limitations on that. So, as you would expect, if you make too much money, then you no longer qualify to open up a Roth IRA and instead would have to open up a traditional IRA where it doesn't grow tax-free, but there's no income limitations. Now, the backdoor Roth IRA gives someone that earns a lot of income the ability to still open up a Roth IRA. And they do this in an incredibly easy way. They do this by opening up a traditional IRA, loading it up with some money, and then immediately converting it into a Roth IRA. They get approved for the traditional IRA because there's no income limitations. And since they already have the IRA, it's real easy to convert it into a Roth, totally negating the income limitations that opening up a standard Roth IRA would give you. In a sense, this proposed policy would disallow all conversions, whether it's from Roth to traditional or traditional to Roth. That way, it shuts that backdoor method for the high income individuals to no longer be able to have access to tax-free growth. But at the same time, they're also encouraging you to do this as much as possible right now because that wouldn't take effect if approved until 2031. Meaning theoretically, you have an entire decade to get your things in order and get this Roth IRA conversion in place because as of 2031, if this policy gets approved, it will no longer be authorized. Now you might be thinking to yourself, 2031 is an entire decade away. What's stopping some other politician from changing this policy? And honestly, the answer is there's nothing stopping them. But they don't want to initiate this policy right away because the taxes that the government earns converting traditional to Roth IRA make up a good portion of their revenue. So why give up on that revenue immediately? Instead, let's just push it off until the end, collect some of the revenue we still get from this, and then in time it'll be phased out. That's the mentality and the thinking behind this. Although quite frankly, I think in the future, someone's going to change this and remove this from happening. Now, the second proposed policy is to remove accredited investments from IRAs. And if you're wondering, accredited investments are investments made by accredited investors. Now, what's an accredited investor versus an investment? Well, the accredited investor is someone that matches one of these three categories. They either make $200,000 or more per year, have over $1 million in net worth, or hold a Series 765 or 82 series security license. Matching any of those three would make you an accredited investor and give you access to accredited investments. These are private equity investments, meaning they're not listed on the stock exchange and they have not gone public yet. Usually these are new or smaller companies that really wealthy individuals or accredited investors like Warren Buffett invest in to get a piece of the private equity. And then when the company goes public, they sell their equity for massive gains. Now, I think the whole reason this particular policy was proposed is to stop future unicorns like Peter Thiel from happening. If you don't know, Peter Thiel was a very early investor in PayPal before they ever went public. He used his Roth IRA to invest $2,000 into PayPal before they had gone public. He was doing a private equity deal because he was an accredited investor. Fast forward to the present, PayPal is an extreme success. They've gone public and are doing amazingly. But that initial $2,000 investment that Peter Thiel did is now valued at over $5 billion, and it's all tax-free because it was in his Roth IRA when he made it. Now, if this was approved, it'd go into effect sometime in 2022, which is next year. But if you already have an IRA with accredited investments in it, you have 2 years to somehow get it out of that IRA. Otherwise, you'll lose the tax benefits of that IRA altogether. The next policy is to put a hard cap on what you could have in a retirement account. Now, notice how I didn't say just IRA. This is because it is any retirement account. It is an IRA, Roth IRA, or any defined contribution plan like a 401k, 403b, 457b, anything like that. If you have a combined value between these accounts of over $10 million, then you're forced to sell 50% of the excess every year until you bring that balance back down to zero. And likewise, if you have these balances over $20 million, you're forced to sell 100% until you reach $20 million. Then it goes back down to the 50% ratio until it reaches $10 million. But before you freak out, remember that this particular policy is only targeting people that have an earned income of $400,000 per year or greater. So if you don't have an earned income of that much, and you just get lucky with a lot of your investments and your value grows to over $10 million, as long as you're not earning that $400,000 per year or more, you don't have to worry about this particular policy. Number 4 puts more restrictions on self-dealing and investing in your own businesses with an IRA. Now, currently, you're allowed to use an IRA to invest in a business that you own 50% or less of. However, if this policy passes, a new restriction is placed, and instead of 50% or less, it is now going to be 10% or less. Now, the 5th potential policy change is increases to the earned income tax bracket and the long-term capital gains tax bracket. Now, specifically, it only affects the very top tax bracket, but with the income tax bracket, it would be raised from a current 37% back up to what it used to be of 39.6%. Rounding up, it's about 40%. And likewise, the top tax bracket for long-term capital gains would go from 20% up to 25%. And lastly, the 6th potential policy that I want to talk to you about today is implementing a 2% tax on stock buyback programs. And in my opinion, with this particular policy change in and of itself, this is a garbage attempt at raising additional tax revenue. And let me explain why. When a company has excess money after paying all their expenses, their workers, and so on and so forth, they could choose to either save it for themselves and use it to continuously grow their business, issue dividends, a portion of the profits to their investors, or use that money to buy stock back from the investors. Either way, whether it's a dividend or a buyback program, whoever holds onto the company's stock is almost guaranteed to profit. Had they not messed with the buyback option whatsoever, especially because it's a measly 2%, with the increase of the long-term capital gains tax, whether it's a dividend or buyback, in the future, whenever these high-income individuals sell these stocks, they'll earn even more money on the capital gains tax than they ever would on this 2%. So those are the 6 potential policy changes that we could see if this agenda passes. Now, at the heart of it, I understand why they're doing this, and I understand them trying to go after the 1% of our country and attack the quote-unquote rich. However, the three potential policy changes that I do not like whatsoever are the second one that I mentioned, which is the removing accredited investments from IRAs. I don't like this one because in order to become an accredited investor, you need to have an income of $200,000 per year or more. So not only are you no longer attacking just the rich, but it also removes even the option of a traditional IRA to be invested in private equity or accredited investments. The second potential policy change that I have an issue with is the self-dealing policy change. And this is just because that finding loopholes to this particular policy change is extremely easy already. Let's say you were the 100% owner of a private corporation that was extremely successful and you wanted to capitalize on some of its growth inside a Roth IRA or traditional IRA. Now, you were 100% owner, so you couldn't potentially do that because of self-dealing. But what you could do is create a separate entity that you also own and have that entity be the 50% owner of this other company and you yourself own the other 50%. Now, although in this scenario, we both know that you own 100% of this company, on paper, you own 50% of the company and this other company owns the other 50%. Now, I get it's a bit of an extreme example, but who's to say that someone's not going to create 9 other entities and instead of having 50-50, it'll be a 10 even split while I still maintain 100% control of this company. And lastly, I'm not a fan of increasing the top tax bracket from 37 to almost 40%. And this is not to say that we should, but I don't think the brackets need to stop at $400,000 or more. Earning $400,000 a year looks and lives a lot different than earning $500 million per year. I think the tax brackets should be extended by all means, but I don't think it needs to stop at $400,000. As well as a survey was done that said the optimal tax bracket is 28%. This is that Goldilocks zone where it's just high enough for the federal government to actually get some of this income via tax, but it's low enough to discourage anyone from finding extra loopholes and doing extra work to avoid paying these taxes. So by increasing from 37 to almost 40%, you're almost incentivizing the wealthy individuals to find loopholes and other ways to avoid paying these taxes. And honestly, just in the time it's taken me to record this video for you guys, I've thought of 3 additional loopholes that people could potentially use to negate all these potential policy changes. One is employee business loans, where the business loans the employee some money. It's common knowledge that loans are not taxable. So if you owned a business that you were also getting paid as an employee, like a CEO, instead of actually collecting a check and having to pay those high income taxes, you can have your business loan you the money and then set up a defined comp plan to pay those loans back. Just by doing this, you've gone from potentially paying 40% in taxes to theoretically paying 0% in taxes. The next one for businesses and for individuals is to just increase your business expenses. Business expenses trickle down into personal returns if you have your entity set up this way. So increased business expenses means more tax deductions at the end of the year and thus less tax liability. And lastly, to negate every other IRA rule out there, you can do an LLC IRA partnership and theoretically still have access to doing everything you've been able to do regardless of if these policy changes get approved or not. I hope you got value from this video. If you did, please remember to like and subscribe as it really helps this channel get out there. I hope I helped educate you and shed some light on some of the potential policy changes that could go into effect if this Biden agenda tax bill gets approved. If you ever had a question, comment, want something addressed, or even wanted to recommend a topic for a later video, feel free to message me on my dedicated Instagram or Facebook account. I don't post there too often, but I'm on there scrolling pretty much every day, so that's where you can easily reach me. Either way though, the choice is yours, and I'll see you in the next episode.